Now, the part of the show where we talk about three things that individual investors need to focus on before you make your investment decisions. The Fed December rate cut expectations have jumped. Yes, just a few weeks ago, we weren't expecting a rate cut, and now it seems like there's a very good chance we will get a rate cut. Very important. We'll all be focused on the Fed come the early part of December, I think somewhere around the 10th of December, and let's see what they have to say. Canadian bank earnings, they're coming out next week, within the next week or so. I'm looking for some good earnings, but as you're going to see shortly, we're coming into the earnings season on a high point. And whenever you come in at a high point, maybe you're going to get a sell the news phenomenon. So investors have bought into the banks heading into earnings season, but maybe once earnings come out, could we see the market for the bank stocks, Canadian bank stocks, sell off a little bit? I think it's quite possible. Individual investments have limits. They don't keep going in a straight line all the way to the moon. And, I've heard us talk about Nvidia, can't sell our Nvidia shares because they just keep going up. Why would I do that? We can't sell our Apple stock. I heard that for many years as well. Things always have their day where they go up, up, and then eventually, don't go up as quick or perhaps come down a little bit, consolidate. And over time, good quality companies have their shares do run higher, but nothing goes straight up and to the moon. So we're going to touch on that as an idea to focus on as well. So let's move on to our first topic, Fed December rate cut expectations. And as I said, they've definitely moved up significantly. Our first chart here shows where the Fed has gone in the last little while, target range for Fed funds rates, and you can see how it's starting to come down. And I'm sure to President Trump, I'm sure he's quite happy to see rates come down, but for him, I'm sure not fast enough. He continues to poke fun at the Federal Reserve, Jerome Powell, the head of the Fed, saying that can't wait till he is no longer in the job. And when he replaces him, he will put in someone who is, I guess, friendlier or more willing to cut rates over the coming years. So the market's gearing up for a rate cutting rate cutting friendly Fed head, if you will. I don't know what else to call it, but the market is expecting that interest rates will be cut throughout the year next year. And if that is the case, I'm sure the market will get a boost from it. Our next chart here, Fed Watch Tool, probabilities of FOMC rate cut. And you can see here on the left-hand side, December 10th rate cut as of November 19th, only a 30% chance. As of November 25th, just 6 days later, 84% chance, over 84% chance. And if you go ahead into 2026, you can see right now, they're just under a 25% chance they'll cut again a quarter point. But right now, I guess the talk is that they'll hold pat and they'll stay about a 65% chance that once we get a cut in December, we will not get any more cuts. At least we will not get a cut in January. Now, what changed things in just 6 days? Well, Fed speak, as we often say. The head of the New York Fed spoke, Mr. John Williams, and we have his quote here. When the head of the New York Fed speaks, everybody listens because they are considered a very important part of the Federal Reserve. Let's put up the quote on the Federal Reserve rate adjustment. There it is. I view monetary policy as being modestly restrictive, although somewhat less so than before our recent actions. Therefore, I still see room for a further adjustment in the near term to the target range for the federal funds rate to move the stance of policy closer to the range of neutral, thereby maintaining the balance between the achievement of our two goals. And what their two goals very simply are: full employment and stable pricing. And what this tells me as the New York Fed, John Williams, is focused on jobs and the decline that we're seeing in jobs in the US, although the September jobs number was actually above expected. Obviously, we don't have an October number because the government was closed, so we didn't get that data. But just seems like someone like John Williams, the head of New York Fed, is focusing on that. There are 3 or 4 Fed officials focusing on that and on jobs and think there should be a rate cut. There are 3 or 4 Fed officials that are now focused a little bit more on inflation and think that they need to take things slowly. And then there are a couple of others that are somewhere in the middle. So the Fed is definitely divided. Our next chart shows PPI numbers producer price index. These are their wholesale prices. The main takeaway here is the far right-hand side, PPI and CPI, which are your consumer prices, they still seem to be showing inflation at around 3%. Let's say 2.5%, 3%. That hasn't changed really for quite some time. And that gives ammunition to the Federal Reserve to focus on jobs in this case, although I'm sure Jerome Powell, the head of the Fed, will tell you that they want to see a 2% inflation rate, not a 3% inflation rate, and that a 3% rate is actually 50% above what they want at this point in time. And the Bank of Canada is no different. Although inflation here in our country is much closer to the 2% target than in the US. So inflation, at least for the most part, is stable in the US, but still not coming down towards 2%. Our next chart shows a chart about the US consumer sentiment. How is the US consumer feeling right now? And this tells me a lot. This says the US consumer is not confident. The lowest numbers that we've seen on the right-hand side, those are the lowest numbers we've seen in many years. You got to go back maybe over the last couple of decades before you saw a number, looks like a number around just before 2012 or maybe back in 2008. But definitely it's the lowest we've seen. So the consumer not confident, and that could play out in the markets. That could play out with spending. We know the U.S. consumer makes up about, over 70% of the U.S. economy. So if they're not confident, their sentiment is low, then that is a negative for growth in the economy. And again, perhaps something that the Federal Reserve could say, hey, consumers not confident. We're seeing jobs growth not there. Companies are laying off workers. Amazon just laid off, I think, 13,000 or so. This is an opportunity and the time where they need to cut interest rates a quarter point. So what is the market doing right now? Our last chart shows it's pricing in already a quarter point. The 10-year Treasury now coming down towards 4%, went slightly below 4%, but hovering in around 4%. So I would say it is highly likely that the Federal Reserve will cut rates at its next meeting. Our second point to be focused on if you're an investor right now over the next few weeks, as I said off the top of this segment, are Canadian bank earnings. And I'm expecting really good bank earnings. I'm expecting the banks to report good numbers, perhaps even some decreases in the money they're setting aside for bad debts. I'm expecting their business activity to come up a little bit. We've seen business activity in Canada really slow down like 25% the last time we saw that number. I'm hopeful that that part of the business is starting to come back. It'll be interesting to see what banks say with regarding loans. Are they still lending as much to businesses to grow and expand? What are they saying about wealth management, net interest margin? That is the gap between what they pay interest on and the interest they charge on loans. What is the spread right now looking like for Canadian banks? And what are these banks doing outside of Canada, internationally? Obviously, our banks today are a lot more international than they used to be. Even CIBC has now a lot more business in the United States. Royal Bank, TD Bank, Bank of Montreal, Scotiabank, probably the most global of our Canadian banks with business in Central America and South America. What are they saying about that type of business? As I mentioned, coming into these bank earnings, I'm a little cautious, not because I think the banks aren't going to report good numbers, but I'm just a little cautious because their stock prices have all run up. All the major banks seem to be at either all-time highs or at the very least 52-week or one-year highs coming into their numbers. And we have a couple of bank charts here. TD Bank, after they went through all the negativity regarding their money laundering and their U.S. business, and that business being kind of on hold right now, they can't expand it. Look at the chart for TD Bank. Unbelievable. From mid to high 70s stock price to over $116 per share. Bank of Nova Scotia, the one bank that was sort of left behind, undergoing a restructuring. Well, obviously that restructuring has been fantastic. Look at that share price. Again, going from as low as $65, $63 a share at the low to $95, 50% return. Unbelievable over the last little while. And our third bank, which is a bank, our largest bank, the bank that has been just humming along for quite some time, Royal Bank. I think if anybody has owned shares of Royal Bank, even though it is one of the more expensive banks to own in terms of earnings per share, PE ratios, etc., it just seems to keep climbing. And yes, I guess it's been climbing a little more gradually than the other banks, but still climbing nonetheless. And when you take a look at banks in general, these are all the banks, major banks. We have an ETF, the Hamilton Enhanced Canadian Bank ETF, and this will show you how well the banks have done. So heading into this earnings season, little concern, right? A little concern that, maybe the banks have run a lot. And when you tend to see times like this, maybe you get a bit of a sell-off when the numbers come out. Again, we always say you buy the rumor and you sell the news. Well, the rumors are bank earnings are going to be just fine. And when it actually comes out, maybe the banks just don't take another leg higher. Maybe they just stay stable or maybe even pull back a little bit. If they pull back too much, that gives us another buying opportunity. So we'll have to watch what the Canadian banks say. Our third topic of our top three, individual investments have limits and they just don't go straight to the moon. And it's interesting because the last time we talked about a stock like Nvidia going to the moon, can't sell Nvidia, just going to go up, up, and up, it was Apple stock. And let's show a 5-year number, a chart on Apple shares. There you have it. Well, that doesn't look like a stock that has gone to the moon over the last 5 years. It's gone up, it's gone down, very volatile. Recently, it's gone a lot higher. I think with this whole idea that Apple is going to be using Google or Alphabet, Gemini, AI for their products. And we've all been waiting for Apple to get into the AI game. And so far, they've been holding off for whatever reason. But their new iPhones were a hit globally, even in China. And that has given them a recent a burst to the upside. Let's take a look at Apple over the long term. Again, do stocks move higher over time? Yes. But you can see the pattern of Apple. Goes up, comes down, consolidates, goes up, comes down, consolidates. And you can see if you look at a chart, on this chart even, if you look at towards the end of 2021, that was approximately the same value as it was at the beginning of 2024. Nothing really moved higher much, maybe a few percent only. And then when you look at, I guess, a chart 2023 to midway through 25, so maybe a 2-year period, again, Apple really didn't do much. So you'll have periods of time where these tremendous companies, these massive companies, Apple, first $4 trillion company, now it's still there. It's in and around 4 trillion. Sorry, Apple had the first $3 trillion company. Nvidia was the first $4 trillion company. Nvidia is the first $5 trillion company as well. But Apple, being the first $3 trillion company, finally got to $4 trillion in market cap. But really, the stock has been a laggard in the tech space. Perhaps it's because earnings were growing at around 5, 6, 7%, and the earnings multiple, or PE, was over 30. That's an expensive stock to me. So while a name like Apple or other stocks that kind of take off and consolidate, what should you be doing? Well, you should have a diversified portfolio. You should be owning other names, not just Apple or Nvidia or other tech names. You should be owning different tech names, different banks, different names in other sectors. And I have a few here. So while Apple is consolidating, let's own some JPMorgan. Let's pull up a stock of or a chart of JPMorgan. Look at that chart. Come down a little bit over the last, let's call it, month or so with the markets. But JPMorgan has had a fantastic run. What other name can you own? Well, let's look at a pharmaceutical name, Eli Lilly chart. A lot of people say pharmaceutical has been dead, and it has for a little while. But why do you stay diversified? People tell me all the time, Allan, why are you owning these pharma stocks? They're not going anywhere. Let's just own more tech. Well, this proves you wrong. Eli Lilly, first $1 trillion pharmaceutical company in the world today. Eli Lilly, famous for their GLP-1 drugs, the weight loss drugs, but they have a very strong pipeline of other drugs as well. And finally, Eli Lilly is being rewarded. So if you had a diversified portfolio, own some Eli Lilly as well. Eli Lilly, JPMorgan, maybe some Nvidia, maybe some Apple, and maybe some TD Bank. Let's take a look at TD Bank stock. Chart that we have there. We showed already what TD Bank stock looks like. Maybe you want to own a Canadian bank. Maybe you want to own a great industrial name, a large company that benefits from building, from infrastructure building. What are you going to take a look at? Maybe it's Caterpillar. Everybody knows the machinery company, the big heavy machinery, the big bulldozers. Caterpillar actually now is benefiting from the data center build out. Why? Because you need these big turbines, and these turbines produce energy, and these energy you need for these data centers. And Caterpillar produces these big turbines, and that is one of the reasons why we're seeing Caterpillar stock move significantly to the upside. So stocks don't all go to the moon. And when they pull back or consolidate, you want to be in other names that can pick up the slack. So you want to have a diversified portfolio. So 3 things to consider before you make your investment decisions. Number 1, keep an eye on the Fed. What are they going to say at their next meeting? Number 2, maybe even in the shorter term, bank earnings, Canadian banks. Don't be surprised if we see a bit of pullback on the earnings release, but I think these banks will continue to go higher over the long term as they have for many years. And last, just remember, don't always chase the hot stock, because stocks just don't go straight up all the time and go to the moon. They have their periods of consolidation and flatlining and actually coming down. And when they're in that type of state, that type of environment, you want to be diversified into other names so that your portfolio can continue to grow even when these hot stocks sort of slow down.